two recessions. It survived the last two. So the last downturn, 2008, and the one before that. And the reason why is because it's a disruptor asset class. It relies on life events. So disruption is a good thing for storage. So when the economy is doing poorly, people are moving, they're job relocating, they're divorcing, unfortunately, they're downsizing, they're selling their big home and getting a smaller home or getting foreclosed on. They're on the move, right? Something's happening. When a bunch of businesses close temporarily for 6 months, where does all that stuff go? They move out, right? So they have to put it somewhere, and that stuff has value for a little while, right? So they have to put it somewhere into it.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik, and with me, as always, is John Cohen. How are we doing, bud?
We are doing good. I am finally getting a coffee machine that I ordered in 2016.
No way.
From Kickstarter. I got an email today to confirm my shipping address. It's shipping. I actually texted my wife. I said, "You'll never guess what's coming." And she said, "Get the fuck out of here." So I had to tell you because you were there when I ordered it.
Oh my God, that was ages ago. I forgot about that thing.
As did I. But luckily, they sent the email out because it would have been shipped to the apartment that I don't live at. So it was crazy. Now we'll see if it's all it's hyped up to be. I've been waiting, almost 5 years for a coffee machine. So we'll see.
Do you even have any space for it or no?
Not a bit. No, we are going to. We'll figure it out. We'll make it right. We wait 5 years for something, right? Something gets to go in the garage or the basement, and this will be the new tool, the new toy for probably a couple months before I want to buy something else.
That thing better make the most perfect cup of coffee at the perfect temperature without you having to lift a finger. Better
or be a complete disaster.
Oh, it's definitely going to be a disaster.
I don't know when it's coming. It just said it was being shipped. There's no shipping number or anything like that. So this could just be could buy them another 5 years.
Exactly. Yeah, you'll get it in 5 years, just in time. Wow, that's funny. Yeah, that's why I don't do Kickstarter. So I saw you do that and I was like, I'm never doing that ever. Not worth it to me. I'd rather pay double or triple to know I'm going to get it.
Hey, listen, if someone would have given this to me for twice the price, I would have paid for it to have it instantaneous, right? Instant gratification. So, no, I buy into that. You are speaking my language there.
Wow. That's funny. I'm happy you mentioned it because that was a long, long time ago.
I thought for sure the money was gone. I would have.
Oh yeah.
Betting man, I would have said no shot. Through Corona, through all that, ordered it 5 years ago. It was goodbye. I was going to call my accountants and tell them to write it off this year, but no, it's coming. So, well, actually, I shouldn't say that. I got an email said it was coming, but that doesn't mean anything. We'll find out shortly.
We'll leave it when we'll see it. But I appreciate the update. I don't know if anybody else does, but good to know. But let's jump into today's episode so that we don't lose everybody right away. Got a really great guest on today. Excited to hear about him, hear his story, and just kind of chat. So that being said, Ryan, thank you so much for hopping on.
Yeah, thanks, Chris, for having me. I appreciate it.
Yeah, you got it. So kick us off. Tell everybody a little bit about you, what you do, your journey, all that great stuff.
Yeah, so co-founder of Spartan Investment Group, and we own self-storage and operate storage and RV parks. And we have about 10,000 plus doors or pads or units spread across about 6 states. And we have about 50 employees now. And we basically use syndication as a tool to fund our deals. And then we do the whole thing. So we have the construction company, property management, asset management, and then we have an investor relations department here at Spartan that raises capital and interacts with our investors. And we've been in business since 2013. And it all started in Washington, D.C. when I met my business partner, Scott Lewis. We met as neighbors, became friends and started a business together. He has a background in the military, and I had a background as an airline pilot. So that kind of brings us to today. We're headquartered in Golden, Colorado, and then we also have an office out in Seattle. Mm-hmm. And 2020 was a great year. We broke ground in about 1,300 units. So we do ground up construction as well. And then we do we buy existing facilities and operate them, expand them, put our efficiencies on them. And that's been kind of our growth over the past few years. In 2021, Spartan is going to buy 24 new self-storage facilities. We have about 12 under contract. We've closed one already this year, and we're going to add about 150 million to the portfolio. So it's expansive growth in the past couple of years.
Love it. I think it's great to hear.
Yeah.
So question for you, because I think it's interesting. Did you get started in this self-storage and RV, or did you matriculate it over from, single family or multi, which, you tend to hear more of?
Yeah. So we started building condos in Washington, D.C.
Okay.
That was our primary start. So we started in development and then sort of migrated over into storage over time.
Mm-hmm. And
Yeah.
what was that journey like for you? I think, probably not anything that nobody's heard before, unless it is different, but, what attracted you to the self-storage space? And I think, the RV space, and I don't know how much of your portfolio that is, but I think it's a little different because
Sure.
I tend to hear more people stray away from that because they say, mobile home, but people can just drive away. And I'm curious
Sure.
what, your thoughts are there.
Yeah, it's workforce housing, so it's a little bit different than like a campground. But we have our journey over to storage was because it was the least foreclosed upon asset class during the last two recessions, and it performed the best. And when we were in residential, we kind of thought that residential was sort of hitting its peak in 2016, which obviously still had a few years left in it.
Just a few.
Yeah, just a few. But we really wanted to protect the downside. So that was one reason. And then the ease of operations, ownership, and construction, having, 10,000 units and, about 10 to 20 toilets total, is a bit more easy to manage. So we like that. And then we like that we could bring it all in house and kind of manage. We have a Free Up Storage national brand now that we operate our storages under, and we've rebranded it, I think 10 facilities this year into the new Free Up brand. And, the RV parks, we sort of stumbled upon that. And they cash flow really well, and they have a low cost basis. The trick with RV parks is getting them financed. So we just use syndication on the equity side. And then we also raised a private debt note to buy them. So that was kind of how the RV parks have gone. They did really well up until about COVID. And then they're out in West Texas in the Permian. So they didn't do so well during COVID, but they've been breaking even or profitable even during the worst times. So it's been a really nice investment. They cash flow like nothing else, really. We bought one of them was operating at about a 40% cap rate for about 2 years. So it's based on purchase price. So they're cash flow monsters when they're really going. So
gotcha. I think that's really interesting that the performance through COVID. What were you guys seeing as kind of all that stuff happened? Was did people become more transient, or was it, just a lack of income? Like what was the reason you were finding?
Well, for RV parks, it was in Permian. So that's where a lot of oil extraction comes from and oil, and so that's what played into people moving away from the area. But on the storage side of things were pretty stabilized for our stabilized properties. They were, there was very little disruption at all.
Gotcha. And, I think the self-storage is something that's interesting to me as well. When I moved from New York to Jacksonville and started doing this, it was always, okay, like, multifamily is great, but what else can we do? And I thought, self-storage might be a little bit easier because I think there's probably, like you said, no toilets. You can probably automate a lot of things. You're still a little bit more tuned in 24/7. It's still a service industry in the grand scheme of things, but really curious, what you see as like all those benefits are to it besides just the recession proof. Like, why is it something that you started into and then you've just continued to expand and expand and expand upon? Like, is it supply and demand? Is it really just the management? Like, what's the overall thesis for you guys?
Yeah, so I would say just like multifamily has its tax benefits and scalability. And we see our tenants stay about 58 months on the average across the portfolio. So we have a long-term stay, very little turnover. we have ease, but I think the difference is ease of booking. People can go up to our gate and book on their phone, book online,
Mhm.
book with a call center. So we don't have to go through a big leasing process. We really like that. And we make our facilities, a lot of our facilities are fully automated or have a lot of automation tools in each one that make the friction of booking very low. So
Mhm.
we really like that. And we also really like the fact that, you can really build a portfolio of storages nationwide, and it becomes very attractive to the REITs and institutional buyers. We've seen a lot of transaction activity in the last year. Blackstone bought Simply Self Storage for 1.2 billion,
Mhm.
and they were just trying to put dollars into the asset class as a flight to safety. And we also have Bill Gates got into storage in the last quarter of 2020. So there's a lot of consolidation. And when you build up a portfolio of self-storage, you can get in a compressed cap rate based on having a pretty big portfolio to sell.
Mhm.
We really like that scalability aspect of it, where you can build a big $500 million storage portfolio and then sell it for a pretty price, when it's stabilized to a bigger institutional buyer.
Mhm.
Really like that.
Did you guys have any, when COVID hit, was there any thought that, because it almost sounded like, doesn't make sense, right? Well, maybe it makes sense, but it didn't get foreclosed on when everything, went upside down last time. And what do you think the reason for that was? And then slash, when this happened, did you feel really safe because of what happened in the past? Or did you guys look at it and say, uh-oh, if people can't pay their bills, are they going to pay for this? And can you
Yeah,
speak to that a little bit? Because it's a very intriguing space that I think people question, why do people pay it if they don't need it or they have other things that happen? But can you speak to that a little bit?
yeah, sure. So the last two recessions, it survived the last two. So the last downturn, 2008, and the one before that. And the reason why is because it's a disruptor asset class. It relies on life events. So disruption is a good thing for storage. So when the economy is doing poorly, people are moving, their job relocating, they're divorcing, unfortunately, they're downsizing, they're selling their big home and getting a smaller home or getting foreclosed on. They're on the move, right? Something's happening. When a bunch of businesses close temporarily for 6 months, where does all that stuff go? They move out, right? So they have to put it somewhere, and that stuff has value for a little while, right? So they have to put it somewhere into it. And so we saw a lot of businesses use storage. We saw a lot of disruption, unfortunately, in the industry. And storage is a benefactor of that. And it really proved it this time. I mean, it again, for the third time, we saw a disruption and we saw people flight to storage. The other thing is it's not a $1,100 rent. It's $75. It's $100. So for that little rent, if you've got your stuff in storage, you're not gonna go and take your stuff out. It's not something that you need and rely on. The other thing that we really like is the fact that, and what really helped it was in the lease, we have a lien against the person's belongings. So if they don't pay, we have a leverage to get that money back through an auction process. So I think that really helped it survive and thrive really in the last couple of downturns.
Mhm.
Now that's super interesting because from the outside looking in, I think most people would look and say, "Oh, well, if I don't need it, why would I pay it?" But because of all those things you laid out, obviously it makes a ton of sense. Now, knowing that, like every other product that's been out there, where have you seen pricing or when you guys look at a deal, closing on 12 and having, wanting to buy another 12, 24 this year is phenomenal. But where do you guys see the opportunity? Is it just mass accumulation to sell it at a compressed cap rate? Or not only are you looking at each individual deal by itself, but, where are you guys driving value and things that you look for to, chunk off that, that strategic goal that you guys have on acquiring so much and doing what you're looking to do?
Yeah, so the compressed cap rate sell at scale is just a one exit strategy. We underwrite each deal individually, and we actually expand the cap rate on our underwriting. So we're not banking on a 100 to 150 basis point cap rate compression or anything like that. In fact, usually our cap rates float about a half a point or about 50 basis points by the time we sell. So we look at a couple different things. Our number one value add, our bread and butter, our vanilla ice cream cone deal is a 40 to 60,000 square foot facility that we have expansion potential on. So we just wrapped up delivering 40,000 square feet, about 238 units south of Dallas, where we bought a 9-acre site. It already had about 9 buildings and about 60,000 square feet. And so we added additional units to that business, and then we're going to lease them up. Otherwise, when we do operational turnarounds, usually the owner doesn't have online sales. They don't have a call center. They have a sign on the door that says, "Call me if you need a unit." And are they on vacation? Are they out? Where are they at? That doesn't have a really professional business management aspect to their business. So we optimize that, and we look at that market rent comps. You can look at the market and say, "Oh, this guy's 100% full," but he's 100% full because he's 20% undervalued. So we come in and we'll optimize that. And then there's a whole litany of things. Online auctions. Sometimes the owners don't want to do auctions. They just don't want to deal with that. So we do auctions. That's a revenue driver in a lot of different ways. Not on necessarily the profit of the auction, but it's just getting that unit back, and then getting a new customer paying full market rate rent in that unit is a big revenue driver for us. And then we make our storage as a place of convenience. So U-Haul rentals, you're not going to rapidly increase the NOI with a U-Haul business. In fact, sometimes you lose money. But that brings people to our property, so they think that, or they know that, hey, I can come there, I can move my stuff, and I can use a U-Haul truck. And that really helps bring in customers. We also do things like cell phone towers, ice vending, locks, retail servicing, and then we do tenant insurance. Tenant insurance is a major source of income. So we'll have a preferred vendor. We can't force them to use that vendor, but we can require tenant insurance in some locations. And so we'll do a revenue share of about $8 a month per unit. And it adds up when there's 700 units at a property or 1,000 units at a property, when we have that requirement. So there's a lot of little different things we can do just to optimize revenue and drive that NOI up and get the value out of the business, in addition to just the raw expansion.
Yeah. No, I think too, with self-storage, a lot of times you got to look more at percentages because the dollars are so lower. And you're saying it's, if people are paying $100 a month and you're getting an extra $8, I mean, that's 8%. That's not insignificant. You try to do that on, multifamily or apartments or single family, and you're trying to increase your rent 8%. Well, you're going to probably have to spend some money to do that. That's going to be a few $100. So, it's sometimes I think people don't realize how significant that $8 can be, whether it's 700 units or even if you have a much smaller park too. That's one of the nice things about it. And it's also too, it's really interesting when the dollar amounts are so lower. I guess it's probably a good thing and a bad thing, but an extra dollar can be a larger increase to NOI and returns and stuff, when it's really like, it's $1, right? Like nobody's going to not, like if you raise somebody's rent $1, nobody's going to be like, fuck those guys, I'm not paying my rent anymore or whatever. They'll probably be like, all right, it's an extra $1. That's kind of annoying, but it's $1. But that could be 1% or even more, which would be a lot tougher, or probably a lot more dollars on something like multifamily, which I've always felt was something that was super compelling, but I guess, it could also hurt you as well.
Yeah, it's interesting you say that. So we see a 7% turnover when we raise rents. And so, we'll raise rents on 200 customers and we'll see about a 7% churn. It's not a bad thing though. It's actually kind of welcome. We expect it, we like it, and we market for it. So if somebody moves out, now we have the opportunity. Let's say the market rent is $100 and they're paying 60, and we move them up to 85, slowly boil the frog, and they move out. Right. Well, then, our heavy marketing that we're doing in a market, now somebody moves in at 100. So instead of taking somebody from 60, now you've got a new customer at 100. So turnover isn't bad. It's actually an okay thing. And it's now you've got a new expectation of that customer. They walk in, we want them to have insurance. We want them to pay the higher rent. They move in, there's that expectation going in of what it's going to cost. But usually 3 things happen when people get their rent raised. One, they look at their competitors and they realize that we're still below the competitors' rates. So why would you move? You got nowhere to go. Two, they decide that, I don't need the storage anymore, which is pretty rare, about 7% of the time. Or three, they just pay it. So, realistically, and three is usually the most likely. So it's usually a pretty non-event for us. The other thing is we're on month-to-month rent, month-to-month leases, which, that might give a lot of people heartburn because, it's only month to month, but that gives us the opportunity. We could increase every month if we wanted to.
Quick question. There's got to be a cost to move as well, right? If someone rents a truck, forget the time component of it, but when you raise the rents, what's it going to cost that person to go rent a truck, move down the road, time, energy, and effort? I don't know if individual tenants are necessarily doing the analysis, but I know for me, you can raise my rent a little bit, for me to go get a truck, pack everything up, drive it down the block, and the rent's going to be comparable. What's the point?
Yeah.
So you obviously have them there as well, where people listen. Storage is, like you said, a disruptor anyway. Do they want to go through another disruption? And the answer is probably not. If it's not if you're going to raise the rents $50 over what market, then you're having a conversation. But if you're below market, you should be able to capture that. In the numbers you just showed, should be pretty easy.
Exactly. Yeah.
So my understanding, and correct me if I'm wrong, is kind of one of the bigger cons or bigger risk is the supply and demand metrics in the market and the submarket. When you were talking about, Blackstone coming into the space, Bill Gates, and it just becoming more popularized through, the cap rates you can get, the automation. I mean, I understand that if other people are looking at it and, just someone like me is even thinking about it, that's more and more people looking to come into the space. And, you can buy a lot more lots or real estate or land for lesser dollars. Do you have any worry about a asymmetrical oversupply and thus it's going to hurt some of your stuff? Or do you guys how do you guys look at that and combat against that?
Yeah, it's a great question. So yes, the supply concern is there right today. That's the biggest threat to the industry is supply and demand, but it's not a macro level concern. It's a micro level concern. Storage is a 3-mile business. It means that, if you build a facility in a market, it could be in Seattle, Washington, but it doesn't, somebody might say, well, what's the market like in Seattle for storage? It's an inaccurate response because it could be good. But when you look at the actual main street that it's on, the 3-mile market, that's where the demand exists or doesn't exist. So you've really got to understand your micro market to really assess if there's demand. So I'll give you a great example. So there's 7 square feet per person that is utilized in the state of Washington, for example. So if you find a market that's supplied by 2 or 3, and the consumption is currently 2 to 3 people, and there's 10,000 people in that market, you can reasonably assess that there's a room to grow, 4 to 5 square feet per person in that market. And if there's 10,000 people, you might have 50,000 square feet of demand, for example. And then you got to look at what pipeline properties are coming in. So if there's pipeline facilities being built, you have to subtract that from the the saturation or the capture rate that you would get. So we do that assessment when we look at a market. Now, it doesn't keep anybody coming in from the back door, but a lot of the sophistication that's in this space knows how to assess that demand and really understand, hey, it doesn't really make sense to build. And a lot of lenders know that too. So lenders will assess your deal and they won't write a check without a feasibility study that gives you that runway to actually build. So while there is a lot of money in the space, in fact, an interesting statistic I heard the other day, Blackstone, Cascade, and 2 other groups could buy everything that transacts in storage and only be 0.2 of their platform. So there is so much money in the space, and that doesn't even include all the regional, national, smaller guys, right? Or even that doesn't even include the REITs. So there's so much money in it that it's really hard. And you might think, well, geez, what's the deal? There's just not a lot of them. There's only 60,000 facilities in the country. Think about multifamily or single family. I mean, there's 60,000 multifamily facilities probably in one given market. So we have to look nationwide to get our deal flow. And it's extremely difficult to find that right property with, the correct value potential to move forward with. So we have 4 full-time acquisitions people at Spartan that, it's all they do.
Mhm.
They just look for deals, and we're growing that team. We're probably going to double that team this year because just we want to have the deal flow that makes sense, for what we're trying to get.
No, for sure. I mean, one of the things that I did when I came down to Florida was look at the supply for apartment buildings to buy in the area. And it was, if you go down to 2 to 9 units, I mean, there's, thousands. If you stay, even in the 10 plus unit space, there's hundreds and hundreds, over 1,000. So ton of supply. And I was like, okay. And I pulled that right from the county. When I pulled it from the county for self-storage facilities, there was like 70 or 100. And I said one of two things.
30 of those are owned by, publicly traded companies, probably.
Yeah, and some of them are like brand new ones in infill locations. So I was like, okay, if you split that in half, that's probably the half that I would even, have a chance of buying or think about buying. And I was like, God, like I said, one of two things. I either said, one, it's really undersupplied and that's interesting. Or I said, two, it's just, there's not a, storage just isn't as prevalent as it is in other spaces, even though I find it interesting. So it's kind of sounds like you're saying that, hey, that's that's a trend you're going to see in most locations. Like, self-storage may be the greatest thing since sliced bread, but there's just not a lot of assets out there. And even two, the dollars in the assets aren't nearly as high as compared to some other asset classes.
That's correct. Yeah. Like we set out to add 150 million of new assets this year.
Mm-hmm.
2021, and it's extremely difficult to even be able to place the equity and the cash into the space. There's constantly people that want to write big checks and go into storage, and it's hard to even place the dollars in the space. That makes sense. That actually, are deals that are worthy of taking down for the expectation that you have for, value add or core assets. So it's definitely interesting. I mean, we find ourselves, we've actually got a lot of deal flow right now. Due to our efforts on increasing our acquisitions team, but we also do, we're also very open to the markets that we go into. We look at 154 different markets, and, we're also very open to construction. So those are kind of the, ground up construction. So that's why we built out our construction side of the business as well.
Mm-hmm.
So the construction piece is interesting because I've had a couple of people approach me with some deals, and like the multifamily side, we look at construction and we say, well, the cost to build is crazy. You're going to need a crazy rent. How does that break down to the storage side? Because you have to assume the same thing.
Exactly. Yeah. We won't. So we love building in the Pacific Northwest. Rents out here are $20 to $24 a foot, which is high for storage. But, building in Oklahoma, tough when it's, the rents are $4 or $5 a foot or $6 a foot. Generally anything, and this has changed a bit because steel prices are up about 85% since December. And it's killing projects. It's unfortunate, COVID shutdowns, we've had, kind of a backup in inventory, and now everybody's out building. So all the materials are getting picked up. So prices are escalating. So, there's a little bit of a pause right now, not on our projects. A lot of projects are out of the way. We already got our steel prices locked in. So it's not a big deal, but you're right. I mean, there's some markets where we can pay $50 a foot to build our storage business, and earn out $12 or $13 in rent. And that makes sense. And there's some markets where we have to pay, not because of labor or anything like that, but just because of the site. The site has bad soil, because that's, in being in construction, this, like, getting it to a foundation is the hardest part. And then everything vertical is easy, right? Because anybody can go vertical, and build a building, but it's what does it cost to get to your underground utilities and your site work cleaned up to go vertical. And we had a project this year that we built in Seattle, and it was very expensive for the site work. So it escalated pricing up to about $120 a foot.
Wow.
But storages are trading for $300 a foot. In this market. So it makes sense, but some markets you're not going to get that because you're not going to get the rents,
Mm-hmm.
So, and then the demand might not be there, which is even worse because, you spend $10 million building a property, and then you're staring down the barrel of a $7 million note, and you've got no demand to lease up your property. That's a bad situation to be in.
100%.
So pricing, rents per square foot and construction costs, and and the site and that specific demand is the key ingredients to making a decision. Yeah.
So one question I have, because we talked about this a lot, where when I was still working at Toro and we were looking at probably a dozen to 20 markets, we felt like we were getting spread thin, right? To stay on top of the macro and the micro and really analyze and stuff like that. And you're saying, it sounds like self-storage is even more micro than maybe multifamily might be. How do you guys stay on top of so many markets and stay up with the different trends and the data and all that stuff? Is it, like you said, you just built a bigger team than, anything we ever had, but even still, 154 markets is a substantial amount of work. How do you guys balance, not getting overwhelmed by too many markets, but also, being able to keep track of all those, micro trends?
We have 2.5 people that focus on the data. We have a data scientist, we have a feasibility researcher, and then we have an intern. So I'm counting that as half. But we have people dedicated to that, and then our second biggest line item expense in our company is data. So we spend hundreds of thousands of dollars on data each year. So any access that we have to data, our team has that capability. So that's huge. You got to know. I mean, there's no guessing. It's not, you don't talk to the agent. The agent tells you something, and this is an up and coming area or whatever. It does not matter. It really doesn't matter. It's the simple metric of occupancy is a big deal. When you look at occupancy in a market, rental rates are a big deal. But there's a lot that goes into the demand calculations to decide if that's a go or no go decision. And we've seen it prove out. Like we just opened, like I said, we just opened a building in Dallas, and we've released 24 units a month so far on the expansion. So that's great. That's a great if you can lease a unit or close to a unit a day on a lease up, it's a pretty good market. So
awesome. So when you're talking about having these people on salary doing all this data aggregation, is it there's just so much data you're getting from public and easy sources that to just compile it and put it into understandable formats it requires people, or are you guys actually working on new ways to actually go out and compile this data from sources that, like, if I was going to look at self-storage stuff in Jacksonville, I couldn't get by just calling people and looking online and things like that?
Yeah, you'll want to look into some data systems that produce that. You won't want to go compile it on your own. There's access, and then you can also do a feasibility study. So I would say our data research is reactive and proactive. Unfortunately, we would love to be more proactive, but we get a deal that comes in, it's a broker, a wholesale, whatever it is, and we have to analyze the deal. So that's reactive. So we react to researching, like, okay, that deal's in Jacksonville. We're actually buying a deal in Jacksonville. We close in July.
Nice.
But Jacksonville, and then we have one over in Tampa. We're buying a portfolio of facilities throughout the Southeast. What we will look at that market and say, okay, what's the demand? What's the saturation? What are the building permits in the pipeline? What's the population? What's the growth? What's the income? we kind of go through the whole thing, and we can extract that data from our systems. That's kind of reactive. Unfortunately, probably 75 to 80% of our data analysis is reactive. Like when we get a deal, we have to analyze it. We have to underwrite it. We have to make sure that it makes sense, that we complete our business plan. The proactiveness is interesting. So we're actually proactively looking in markets where there's a lack of, there's a low saturation of storage and population growth and different drivers. And we're scrubbing those markets to try to figure out places to build that make the most sense. So that there is a little bit of both. So
where do you guys look? Because I think, population growth and trends, but staying up to date as possible is sometimes difficult. Where do you guys pull most of that data from, if you know?
We use Esri as a big one. Radius is a great tool that's used in the industry, kind of union real-time data. Yardi has some good tools. But yeah, and I mean, even Google, if you just Google like a city name and population, it'll give you that growth. Like, I mean, you could, sometimes it's not perfectly accurate and doesn't really get you what you need, but if you're kind of looking at a market and you're like, yeah, that's interesting. And then you kind of just throw it into Google real quick, like, Seattle, Washington population. The first thing you're going to see is a growth pattern over the last 10 years. So it's interesting. You can get a little bit of that, but we also can go deeper into some of the systems that I just mentioned. So.
Right. As COVID happened and as it's kind of shifted all these trends in population, have you guys, because a 10-year lagging indicator is great, it shows a long-term trend and that is great in and of itself. But I think there's probably been a lot of changes in the last 12 months, if not shorter and longer. Are you guys is there any other data points or sources that are maybe a little bit non-traditional that you look at? Are you really focused on the short-term changes, or are you more focused on long-term trends? How are you guys analyzing all that?
We continued our thesis to continue investing in tertiary markets. So, not in the big cities. The big cities are bad for a couple of reasons for storage. Not all of them, but generally, you're going to be competing with the REITs, and we don't want to compete with the REITs. On the tertiary markets, you're not competing with the REITs, and we tend to be in some of the tertiary markets that we're in the best capitalized, and the best and the highest sophistication for marketing and resources. So I'd rather compete in those markets than go try to go head to head with an extra space that during COVID they had an algorithm pricing change, and then they cut all their rents in half nationwide.
Wow.
Right. And there was nothing anybody could do about it. Not even the property owners that had hired them to run their properties. So how do you compete with that? You don't. I mean, they're half off, right? Most customers that we have are price and location. There is no one cares about the view from your storage facility, right? Or that it's got marble, tile or, stainless steel appliances, right? So it's price and location. I mean, yeah, there's a customer service aspect. I don't want to downplay that. And there's an ease of booking and convenience, but at the end of the day, it's price and location. So if you're in a downtown core and all of a sudden a national company that owns, and operates, over 700, 800 store locations just cuts all their rents in half for COVID, you got a problem, right? So, but a lot of those players aren't in the tertiary markets. So we like being in the tertiary markets. We've seen a lot of growth and migration to the tertiary markets. Not that city living is dead, but we've seen a migration, a general trend to do that. So we've stuck to our guns on that, and that's really proved out well for us. The best properties we have are in the tertiary markets, and it's funny. Our investors sometimes look at our deals and they're like, "Man, it's kind of out there." I'm not talking about like middle of nowhere, New Mexico or something, but like East Texas or Bentonville, Arkansas, or south of 50 minutes to an hour south of Dallas, around a major metro airport, but not in the core.
Gotcha. No, I think it's interesting. And while I was looking on your website, I noticed that as well. But I also saw you guys bought a recently converted Macy's deal into self-storage. And I think that's really interesting. So it doesn't look like you guys did the conversion yourself, if I'm reading it right. You're wrong. Can you talk a little bit about that concept of, because I think a lot of people now are talking about what to do with these, big box retail mall spaces that are coming out, and you hear, data centers or, converting them into multifamily or self-storage. What have you guys seen with sort of this conversation?
Yeah. So people are converting big bucket, they're big, black box, big box retail, Walmart, old Albertsons, Shopkos, things that have gone out of business, or have just been kind of sitting idle. And it depends, you can go, everything from super cheap to the whole building needs an upgrade. We bought a Macy's that was converted into storage. We bought it basically empty, and then we're taking it through its lease up. So when you buy a property at C of O, or when it's empty, you get like anywhere from 100 to 400 basis point discount on stabilized value. So that was how we bought that property. We bought that property on a 400 basis point discount. And then we're taking it through its lease up. And then once it's stabilized, we achieve the value through, having a well-occupied facility. So, I mean, there's opportunities there. And, there's conversions that happen. And it all boils down to the same thing, which is, what's the demand? How's the market? Can you get that property through lease up? And then backing into what the costs are to convert the building. But that's a trend that's happening, and it's, some people do it very well, very successful at it. We haven't done any conversions yet. We've done more ground up and, actual, ground up construction and building it. Not because we don't want to do conversions, we just haven't focused on it very much.
Mhm.
But it is something that we are looking at doing. That particular property is in Fort Worth, so all that mention of extra space and slashing prices and difficult and on lease up, we went through that with that property. So
Gotcha.
we're leasing up very well now that COVID is kind of sunsetted, but lease up properties can be hit, when there's people aren't out doing stuff. When you're already there and it's stabilized, that's great. But, as you guys probably saw, your foot traffic at your multifamily died.
Mhm.
Nobody's out looking for an apartment during the middle of a pandemic necessarily. Same thing with storage. No one's going to go, hey, I'm going to go look at that new storage unit I want to go to. Activity basically dropped.
No, 100%. Have you guys seen any difference, small or big, in it being that type of space and that type of location versus a purpose-built self-storage? Or has it just been, hey, it just looks a little bit different, but it kind of acts exactly the same?
No difference. Yeah, no difference. It's built, storage is storage.
Mhm.
And it's funny, people across the United States, they use it in different saturation levels. Like, for example, Florida, there might be a 15 square foot utilization rate. In Washington, there's 7. In Texas, there's 12 to 15. Northern states that have basements, sometimes the utilization rate goes down a little bit per person, but everybody uses storage, and it's, it kind of consistently can be applied, whether it's a brand new, shiny, multi-story, purpose-built storage or a conversion. It's really makes no difference. Visibility from the street, your signage, your drive-by traffic, all plays into how well it'll operate and be leased up, but no real difference.
Mhm. And does it actually have an added benefit of, I don't know if the mall itself is still active
It
and it's
is.
just, stuff like that. Does it get that added benefit of foot traffic of like, hey, there's actually a quote unquote storefront inside the mall, or that doesn't really play a part, or you have no idea?
Not really.
Mhm.
Yeah, the mall doesn't really benefit. I don't think the mall helps it. I don't think the mall really hurts it. It's kind of just a neutral, just happens to be there. The mall is being redeveloped. That's a very nice area of Fort Worth. So they are putting millions of dollars into a redevelopment play at the mall, like housing and some mixed use and stuff like that. So that's good news. But
Mhm.
we pretty much purchased the building as a kind of a standalone. It's connected, but it's going to be a standalone, for all legal and intensive purposes. Yeah.
Gotcha. No,
Yeah.
that's really interesting. So just as as you guys continue to look at placing new capital and looking at deals, is there anything you guys are changing, how you look at deals, how you're buying deals, different locations, or you guys, hey, we've got a business model that works and we're just going to continue to plug away?
We're not really changing. We're constantly evaluating the markets
Mhm.
and, doing environmental scan to be aware of what's going on and what's transacting and trading.
Mhm.
But we are, we're pretty set in our investment thesis, and we're going to carry that out through the end of 2022. We have a strategic plan on our website that kind of outlines, 3 years of what we're planning on doing. We actually might wrap up the plan by the end of this year. I think we're going to hit all of our targets a year
Mhm.
early, which is great. And that's, it was funny when we wrote the plan like a year and a half ago, we didn't realize we were going to have a team. We didn't account for the fact that we're going to have all these employees
Mhm.
kind of helping us carry out our mission. So that's really accelerated our trajectory by having great people on the team. So
Mhm.
that's
So
been,
just for anybody listening, if you high level can overview what that kind of plan is.
yeah. So it's our strategic plan. It outlines our goals and strategic objectives for 3 years. You can download it on our website for free. You don't have to go in and put your email or anything.
Mhm.
It basically outlines 3 goals, and the 3 goals are monetize, 300 million in new assets and build $250 million portfolio. It's offer services and offer additional revenue streams, and then become more efficient. And then there's trickle down for those three main goals in our business. And then it outlines who's accountable and responsible for carrying out those goals and objectives. And it's something that we focus on as a company every month. We go through the performance tracker and kind of go through what we're doing. So like, I'll give you a great example. We're raising probably $100 million this year.
Mhm.
And so in order to get to $100 million, we have to have 12 intakes a day. So 12 intake forms coming in on our website. In order to get that, we have to have so many engagements during the week. We have to be on so many podcasts, webinars, speaking engagements, road shows, property tours, blogs, articles, press releases that kind of feed into that. And we measure that performance, and then we measure its effectiveness. So we have about 3,000 investors on our list now. And then we track the level of engagement of each investor that's on our list. So our average investor is 250,000, but not all of our 30,000 investors are active. We have about 350 active investors. So you can boil that down into how much, when an intake comes in, what the average placement of dollars that would be. So you can kind of see, like, you don't just say, oh, I want to raise $100 million. You've got to break it down into strategic goals and objectives. And then you've got to measure that on a weekly basis or a monthly basis to make sure that you're getting to that target. So we wrote that plan, and, we share it with our partners and investors and prospective business partners, or whoever's, going to do business with us in any way. And it's really helped guide us to grow. Last year we were the 8th fastest growing private real estate company in the United States. So, and this year I think we'll be on that list again. We really have added a lot of revenue and a lot of people and a lot of assets under management. So
love it. That's amazing. And I'm almost upset we're coming up on time, because you just touched on something that I personally am trying to learn more about. So maybe, we'll have to look at a part 2 or something like that.
Sure.
Because I think it's something that's really undervalued. And I think, you've obviously have at least started, if not already proven out how effective it can be. But like I said, unfortunately, we are just coming up on time. So we'll have to figure out another way to do it. But I appreciate you coming on, sharing a ton of insights and knowledge. I think people are going to get a ton out of it. You already started mentioning some stuff, but if people want to get a hold of you, follow you, learn more about you guys, where can they do all that stuff?
Yeah, Spartan-investors.com is our website, or you can reach out, Ryan, at Spartan-investors.com. I'm also on like social media, like Instagram and LinkedIn, Facebook. Yeah. So.
Awesome. Guys, definitely go check them out. Go connect. Go check out that strategic plan, whether you want to invest or you're building your own investment thing. I'm definitely going to spend some time on it myself because I'm ultra curious. But thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from this. Ryan, once again, thank you for coming on so much. This was amazing.
Yeah, thanks, Chris. Appreciate it, John.
Thank you.